Your credit score is where the hype is, but your credit profile is where the magic really is. You see, lenders are actually assessing you on a very deep level, much beyond your credit score. Imagine your credit score being the face or curb appeal of the home, and your credit profile actually being the inspection on the home. You see, you need to understand the various data points that comprise your credit report so you can max them out because lenders are judging you by this. Having an 800 credit score with only 2 trade lines on your credit report versus having a 690 credit score with 20 trade lines on your report is two different animals. And believe it or not, this category over here is usually going to be the strongest because lenders have more data to grade you by. And I want to break down what's in your credit report, how it's comprised, so you can have a better understanding, max it out so you can maximize your borrowing capacity. This is JP from Blueprint for Prosperity, helping you to increase your net worth through relationship banking, maximizing your borrowing capacity, proper use of life insurance, and the ownership of real estate. Like the video, subscribe to the channel. I'm uploading content on a daily basis to help you customize your blueprint for prosperity. So as we dig into this video, I want to cover each category that is covered in your credit report, not only in your Vantage score, but also your FICO score across the board. We're going to cover as many different categories as we possibly can, so you don't have to worry about which credit scoring model or which scoring company that you are looking at or following, and if this is correct or adequate information that you're gauging by. So the first thing, as many of you may be familiar already, is going to be your payment history. Your payment history, whether it be Vantage or FICO, is going to quite honestly and quite simply always be the highest gauged metric or data point on your credit report. It may change what percentage, but it's always going to be the highest. The next one is going to actually break down and be the amount owed to creditors. This is another major one. This is not necessarily in a chronological order, but it is a major one that is considered. How much do you owe various creditors on your credit report? Available credit. Stick to the end of the video because I'm actually going to break down available credit in 5 different subcategories that many of you may not know about. So stick to the end of the video. Types of accounts. This is another sleeper that many people take for granted when building out their credit profile and maximizing their credit score. They don't take the time out to diversify their credit profile. They may have 10, 20 or more trade lines on their account, but the vast majority of those accounts are just credit cards or just personal loans, maybe a mortgage or a couple of different mortgages. They have isolated categories where their profile is built off of, and this is not good for creditors and lenders when they're examining your credit profile because it doesn't show them that you're able to not only handle the credit that you've normally had, but of various different credit accounts responsibly. How long or the age of your accounts? How long have they been open? This is a big one as well. You can't really skip out on this. This one is up to Father Time. Credit usage kind of ties into your available credit, but it's another one of those little subcategories, if you will, that predicates how responsibly you're using your accounts. Having a healthy credit usage is huge to credit lenders because it gives them an indicator if you're desperate or financially stable. Credit mix. Again, this goes back to account types. Now, what's important to understand why these may seem like they're overlapping is because FICO and Vantage use different terminology to kind of describe the same data points. When you start talking about types of accounts or credit mix, these are pretty much the same thing, but FICO and Vantage word them differently. And so this is going to be a breakdown, again, of the type of accounts that you have, showing responsibility across several different trade lines. New credit. So this is another big one that is taken for granted. Many of you don't understand that having too much new credit being pretty much anything under a year old, in some cases 2, can be alarming to lenders because it can start to look like, again, you're potentially desperate for credit. You have to be careful with this one. So, amount owed. This one is where it starts to break out into 7 different subcategories, about 5 of them, and I'm going to help you break that down right now. So, the first category you can consider within amount owed or available credit or credit usage is amount owed on all accounts. This is going to be an assessment of every trade line you have and how much you owe on each trade line, whether a revolving credit account or an installment loan account, real estate related account. They're going to be looking to see how much you owe across all of those accounts. That is one of the 5 major categories within this data point. Amount owed on different accounts. So now they're starting to assess how many installment accounts you may have and how many revolving accounts you may have and how you're managing those accounts based on how much you owe on those accounts. So this is a little bit different than all accounts. They're starting to segregate out what type of accounts you owe the most on. How many accounts have balances? So this one's going to be pretty strong in relation to revolving accounts, but it does include installment loans as well. They're going to be looking to see how many different accounts you have balances on. If you have 20 different trade lines on your account, you owe money on every single one of them. This could look risky. You have to be careful with that. Credit utilization. This one is also a golden nugget. Pay attention to this. Credit utilization is a huge factor on your credit report. It actually can be, in most cases, it's the second most impactful factor on your credit report, but it just can change by scoring model. Your credit utilization, believe it or not, is more advantageous to your credit score or your credit report when you have a low usage than no usage. Think about that for a second. Lenders value you having a low usage on your credit report in the credit utilization section than no usage whatsoever. This is enormously important because many of you may think using absolutely none of your credit cards or going long stretches without using them, paying them down to zero without using them for extended periods of time is the go-to or the proper way to manage this category to get the maximum score. And what happens is when you're not using your trade lines, your revolving ones in particular, you look like you're not giving them any credit to gauge that you're managing. They need to see usage. So you having a bunch of credit cards or a handful of credit cards or just 1 or 2 credit cards, but you're not using them on a regular basis actually looks worse to them because they can't gauge your behavior. They can't gauge your management of these different accounts. And this in itself, what they don't know, they consider risky. So this was a nugget. I hope you paid attention to that. How much you owe on installment loans versus the original amount on those installment loans. So example, you bought a $20,000 car, you've paid $3,000 towards that $20,000. You have about $17,000 left. So that means you have over 85% of that original loan amount still due on that car loan. If you have multiple different installment loans with high balances left on them, this can look risky. So you see, your credit report is extremely nuanced, and this is why you can't get hung up on your credit score. It's very important for you to understand your credit score only gives them a simplified picture of how you've been managing your credit. It does not give them an in-depth breakdown on your financial behavior. And this is the kind of data they're looking for. So again, this is kind of like the difference between a drive-by appraisal, looking at the curb appeal of a property, versus an actual walkthrough inspection of the property, an in-depth full appraisal of a property. Your credit score and credit report break down in this way. Your credit score is like, okay, it looks nice on the outside, but then when they open it up, what's actually going on underneath the hood or behind the curtain? You need to understand these various breakdowns of your credit report if you want to maximize your true borrowing potential. Personal credit card, business credit cards, high ranking auto loans, higher availability of mortgage that you can borrow, right? Affordability rather. All these different categories. If you're looking to maximize your borrowing capacity, whether to start a business, whether to invest in real estate, whatever you're looking to accomplish. If you just want a really, really nice car, you may be looking to afford more home. The more data points, the more diverse your credit profile, the better you're managing various different balances and different accounts, the better off you're going to be on your approval rating. Again, you can have an 800 credit score and only have 2 trade lines. Your likelihood of getting qualified on a deeper level with some of these more complex loan products or some of these higher ranking credit cards is actually going to be lower than somebody who has a 690 or 700, but has 20 to 25 or 30 different accounts for a lender to gauge. But again, because now we can put together your financial picture over an extended period of time over a diverse group of accounts. I hope this is making sense for you. Go back, pause the video, go back over these data points, write them down, or go into your apps and research these data points in your Credit Karmas, your MyFICOs, your Experian apps, and look at this data and see where you sit. If you can get ahead of this before you start applying for new credit, then you can almost guarantee your own approval odds. Diversify your credit profile, make sure it ages, pay it on time, manage your utilization, use your accounts, balance with installment loans. Don't just have revolving accounts. Diversify. If you can get a real estate loan on your credit profile, this stuff matters. You are maximizing your potential for approval, which maximizes your borrowing capacity. I know this was valuable content for you. I want you guys to drop comments down below. Let me know how your credit profile is sitting already. Let me know where you're strong at, where you're struggling at, and let me know in the comment section if you have questions. I actually review the comments myself. If you have questions, I will do my best to answer them. I appreciate y'all tuning in. I enjoy bringing you the content. As always, I want y'all to stay focused, stay in motion. I'll see y'all soon.